We start off with the dreams coming true of all the people waiting for the bank stocks to rally. It finally happened. Check out shares of Citigroup, Bank of America, Goldman Sachs, JP Morgan, and Morgan Stanley all jumping today as rates moved considerably higher. So are the banks out of purgatory for good? Will the banks lead the markets higher? Pete, what do you say?
I don't know if they're out of purgatory for good, but I do like the start of what we're seeing right now. And when you see the 10-year approaching 3.1%, suddenly all of a sudden the banks, everybody wants to look at them once again. And JP Morgan was one of the names that really reacted today. I liked what we saw out of there. And 119 seems to be an area where if JP Morgan breaks through that, I think it actually has plenty of room to the upside still, Mel. So Goldman Sachs, JP Morgan, Citi, Bank of America, all these names, Morgan Stanley, all doing very, very well. There was actually an upgrade of E-Trade today as well. I like the financials. I continue to hold this financials, but I don't know that we can say after one day that purgatory is over with and here we are in this huge bull market.
What would convince you, Tim?
I would argue that banks have not been in purgatory at all. And I realize that if you look at times in this last year and a half, you can pick times that the banks have really outperformed. But Dan and I do this all the time. I mean, you can pick your point in the last since the elections, but financials certainly from before elections are outperforming the rest of the market. If you want to take the day after, because obviously they had a big move, I can argue that it can be very selective. Bottom line, JP Morgan, if you look at their last quarter numbers, record profits. And if you look at the banks, JP Morgan has gone from 102 to 118 really since mid-July. So this move didn't happen yesterday. It's been happening over the last couple of months.
Yeah, but I guess the most important thing is that it hasn't been happening since January, right? So they have been in purgatory. They've massively underperformed.
What's massively underperfored?
Well, you have the investment banks down. Well, hold on, Tim. Can I finish? Because you just do your whole thing.
You're right. No, you're right, man. It's your time.
Till we're
time, buddy.
No, but I mean, when you're looking at, Goldman, Morgan Stanley down 15, 16% from their January highs. We were looking before today at really no major U.S. banks that were up on the year other than JP Morgan and Bank of America. So we've gotten some nice moves after some consolidations, yet we see the broad market consolidating at the all-time highs, and we see the banks consolidating down 5, 6, 7, or even 15%. So to me, it's a one-day action, right? We finally saw the 10-year breakout, but we're also seeing, obviously, a very flat yield curve, too. And so as we go into this rate cycle, we know that we're going to get at least one more rate increase, right, this year, possibly two. I just don't see the banks really performing on a sustained basis. I don't see JP Morgan in a meaningful way breaking out and having tremendous upside in 2019. That being said, you did say it's the must-own stock, and it acts much better, JP Morgan. You said it last week, I remember.
I think it was your final trade that night. Well, I think you piled on, right? Yes, am I right?
Then I got short Tilray.
Well, again, we'll talk. We'll have plenty of time to talk about that. Let's let Guy talk, because he's quiet over there. I want to hear him.
Sure, just run the show, just as if I'm not here. Yeah, go ahead. Go ahead, guys.
Welcome back. We've missed you.
Well, exactly. You leave once again. And what are we supposed to do?
I'm here today. All right, what do you say?
And it's great to have you back.
It's great to be back.
I would disagree on Goldman Sachs. I think Goldman Sachs, the fact management changing, they're completely, in my opinion, changing the sort of the look of the firm, the feel of the firm. So I think Goldman Sachs is going to go through some growing pains at this level. So I'm not necessarily sure it's going to participate with the rest of them. The one that I do like on valuation, and we spoke about it last night, continues to be Citibank, which is up, I think, about 3% today. I think price to book, basically 1 times price to book, report October 16th. If the banks continue to rally on some sort of rotation, I think the most beta-sensitive one, or the one that has most upside, is Citi.
What is the more important driver to the bank trade at this point, Pete? Is it the fact that the 2-10 spread, they aren't so bad anymore? I mean, before we were looking at 22 or so, and now we're more like 25-ish, and yields are moving higher. Or is it that investors are starting to abandon the FANG trade? I mean, today, for instance, we had Guggenheim coming out, raising the price target on Netflix. What did Netflix do? Finish lower.
Right. Well, I do think this has a lot to do with rotation, and it has a lot to do with what has underperformed and where do people want to actually start moving their money towards the latter part of the year. I do think if we see the 10 years somewhere in this range, somewhere over 3, Mel, and maybe all the way up to 3, of course, something like that, I think the banks are absolutely going to outperform. I think the rotation makes a lot of sense. We already know all the earnings. I mean, Tim talked about JP, but that was a known. And these stocks still didn't do a whole heck of a lot. So we know that they have the earnings strength, but it's been about what's the next catalyst. I think part of the catalyst is the 10-year, but the other part is definitely rotation from some of the technology.
Don't you think that this is the point about the rate cycle that we're in? Don't you think we're going to see an inverted yield curve very quickly, very soon?
I think, actually, if you want to compare the graph of the XLF against the Dow, it's the same graph. So, I mean, largely, I think as banks have underperformed, they were underperforming in line with either the industrials or parts of that global trade, implicated, dynamic that I think was pushing down the Dow. The Dow only recently has been outperforming. Dow outperformed again today, and it has been doing that for the last week, much like financials. So I just think if the economy is showing strength into the fourth quarter, the banks are going to outperform. They are the greatest, most leveraged way to get exposure to the economy, and that to me is what's going on. People feel more confident here.
That's been the case all year since the lows in March, as the S&P has been stair-stepping up back to its prior highs, and we've seen a lot of industries that are very economically sensitive actually do very well. You just mentioned industrials. We're talking about transport. There's been, so why haven't the banks? That's really the question to me. So I don't think that you should expect, even if JP Morgan breaks out and makes new all-time highs, Wells Fargo still stinks, okay? All those investment banks still act like garbage. Well, but so I'm just saying, what's going to be the thing that turns it?
I think what you're doing is you're starting to separate and not make it all the same trade, and I think that's the appropriate way to do it. And Wells Fargo has some fundamental issues wrong with it, so does Goldman Sachs. JP Morgan, to me, is the most diversified of the money center banks. It's got the best balance sheet. It deserves the highest multiple in terms of the lowest discount rate, and it's near all-time highs. JP Morgan is basically at all-time highs. What's wrong with that? We're in line with the market. So if you're trading them all as the same, and again, the regional banks outperformed for a long time, and if anybody's most rate sensitive, it's probably those guys.
The VIX below 12, and Pete can obviously speak to this, as can Dan, by the way. We do a great show at 5:30 each Friday called Options Action, which Dan is the absolute star of. But I'll say this, the VIX is probably giving you another opportunity below 12. That's been sort of the level where getting long volatility as protection has been right for the last few years, and here it is again. So the VIX tells you everything's okay with the S&P. S&P wasn't a great performer today, but the rotation, I think, to the banks is encouraging. I think it can continue.
I think that's an interesting point that Dan brings up in terms of being a believer in the improvement of the global economy, or even just the U.S. economy, let's say. So retail stocks, for instance, industrial stocks, what would you rather? Ooh.
Oh, would you rather?
Would you rather?
Yeah, wow. Banks or pick your
banks
other
or the industrials? Right now, in terms of what I think is going to perform most, I'd actually stick with industrials, but I have exposure to both.
But why?
Well, I just feel like they are much more sensitive to what's going on globally as well as in the U.S. You look at something like Caterpillar, right? Look at Boeing. Look at some of these names. And we've gone through this exercise of where do their revenues really come from? And when you start to break it down, it's much more domestic than a lot of people would expect. So I think that there are names in the industrial space that still are cheap. They're putting off incredible amounts of cash, and they have that much more upside, even over the financials. But I have exposure to both. I own Caterpillar, but I also own JP Morgan, and I own some of the other names back and forth. So I'm waiting for the financials, but it's been a really, really long wait. It has been very disappointing, but maybe this latter part of the year, we start to see that really accelerate.
The industrial trade, and whether it's been rails, whether it's been airlines, whether it's even been some of the other transports, I do think it's been a cyclical rotation back and forth. Bottom line, Pete talks about the valuations. They're a lot more interesting in that part of the world. But this, to me, is the way this market has acted for the last 12 months. We've had times where tech has really outperformed. Then we've seen everyone said it was a tech rally over because we get this move back into value. And I think that's where we are. And I think the industrials do have an attractive valuation. I think they're front loading what may be a growth blow off into late October before the trade actually, whatever we're calling it, not a war, an impasse, but the reality is the rest of the world is slower. And I think actually some of those industrials will be hurt.
You mean when the trade actually impacts growth?
That's right, but I think a lot of people are front-loading growth into September and October, and I don't think we're going to see it for 6 weeks.
Yeah, but that's because in a lot of industries, though, we saw ordering ahead of what people expected was going to be a very rocky trade period. So to me, I think you have a setup where you have very easy comparisons to last year. You saw a lot of front-end loading here, and the longer this trade dispute goes on, the greater the likelihood that we see a synchronized global slowing. And then we're going to start seeing guidance that looks for the first half of 2019 very disappointing. And that may reflect itself in lower stock prices.
So when we think about investing in bank stocks right now, are we investing on the premise that the U.S. economy is going to be strong and be somewhat immune to a slowdown globally? Or is it your view, perhaps, that a global slowdown outside the U.S. will then catch up here in the United States and therefore slow down bank stocks as well?
Or door number 3. Which, if you remember
Monty.
Let's make a deal. There's door number 3. And I think door number 3 is the rotation out of technology stocks, out of these high flyers, into banks for the first time that have been underloved and sort of not being a focus for the last 6 months. I think on valuation, banks have made sense, and they continue to make sense. And I thought you were going to play Would You Rather with retailers and banks.
Yeah, I mean, that was another option.
I think Pete blew the game.
Oh,
He definitely let him know.
I gave him the option of choosing the sensitive,
I thought I heard you say
cyclical.
and then.
No, but it ended up being industrials versus financials.
But if you
want to do the retailers,
like
banks,
would you
I
like
think the
to,
retailers now's the time to sort of peel out of some of these retailers that had tremendous moves. We did a power pitch on that JW Nordstrom's a while back. That thing's exploded, as have a bunch of
Was that
other.
yours?
Huh?
Was that your power pitch?
Which one?
JW Nordstrom.
Might have been.
Is that why you're talking about it?
Now.
No,
Royal is Royal
we
do the power pitch.
Well, then he reiterated on Closing Money, which was weird too.
I know that Closing Money show. That's one of my favorite
That's really
shows.
a great show. That's
I
a
think
four,
I think
right?
it'd be a great
show,
off the table
actually.
in retailers. I think you go in the banks. That's a rotation.
It's almost the holiday season.
It is.
It is
no
the holiday season.
No question about it.
We're like 100 days away.
It's also